It's 2 p.m. on a Tuesday. The United States Treasury auctions off another $60 billion in debt. It vanishes in seconds, not because the market wants it, but because the market is being forced to eat it. Look closely at the numbers running across the bottom of your screen. Ignore the S&P 500. Ignore the NASDAQ. Look at interest expense. For the first time in history, the line on the graph has gone vertical. It just crossed $1.6 trillion. Do you know what that number means? It means every single dollar you paid in income tax this year, every cent deducted from your paycheck, didn't go to schools. It didn't go to roads. It didn't even go to the military. It went entirely to pay the interest on the credit card bill. The government is no longer governing. It is functionally a zombie entity, borrowing money just to pay the vig to its creditors. They call this fiscal sustainability. I call it the largest Ponzi scheme in human history. And the math says, the mathematically impossible is about to become your reality. The spiral has begun. Let us place the monthly Treasury statement on the table right now. It looks like a boring PDF, a bureaucratic relic filled with rows of dry accounting figures that the average citizen ignores in favor of sports scores or celebrity gossip. But to a forensic accountant or an investigative journalist, this document is not a balance sheet. It is a crime scene, and the victim outlined in chalk on the pavement is the future purchasing power of your currency. We need to look at line item number 1, net interest. This is the cost the United States government pays just to service its existing debt. For decades, this number was a manageable nuisance, a background hum in the engine of the economy. But in the last 24 months, that hum has turned into a deafening scream. The data projects that for the fiscal year 2026, the annualized interest expense on the national debt will breach the $1.6 trillion mark. Let that number sink in. $1.6 trillion. Human brains are not wired to comprehend numbers of this magnitude. So let me contextualize it with a terrifying reality. This figure is now larger than the entire defense budget of the United States. We are spending more to pay off bondholders than we are to maintain the most powerful military in human history. But that is not even the most disturbing part. The true horror reveals itself when you compare this interest expense to tax revenue. Take a look at your pay stub. Look at the line that says federal income tax. That money is supposed to build bridges, fund schools, and support the social safety net. But the math tells a different story. As of this moment, every single penny collected from individual income taxes is being swallowed whole just to pay the interest on the national credit card. If you are a wage earner in America, your labor is no longer funding the government. Your labor is exclusively funding the debt service. The government is effectively operating with zero disposable income from its citizens. It is running entirely on new debt. It is borrowing money to pay the interest on the money it borrowed last year. In the corporate world, we have a name for a company that must borrow new capital just to pay off old investors, because its revenue cannot cover its operating costs. We call it a Ponzi scheme. When the government does it, they call it fiscal sustainability. This brings us to the great paradox of our current moment, the narrative that is being broadcast on every major news network. The soft landing. You have heard the story. The Federal Reserve has won the war on inflation. The economy is strong. The labor market is resilient. Therefore, the Fed can now cut interest rates as a victory lap. This is the official story. It is comforting. It is optimistic. And it is a complete fabrication designed to mask a desperate rescue operation. You have to ask yourself a very simple question. If the economy is so strong, and if inflation is still hovering above the 2% target, why is the Federal Reserve rushing to cut rates? In a normal economic cycle, you do not cut rates when stocks are at all-time highs and unemployment is low. You cut rates when something is broken, The truth is hidden in the bond market. The Federal Reserve is not cutting rates to help you buy a house. They are not cutting rates to help small businesses expand. They are cutting rates because the United States Treasury is drowning. With $36 trillion in debt, every single basis point in interest rates adds billions to the deficit. At a 5% interest rate, the math simply breaks. The compounding interest creates a liquidity vacuum that sucks all liquidity out of the private sector. Jerome Powell is not pivoting because he wants to. He is pivoting because he has to. He is engaging in a process known as fiscal dominance. This is where the central bank loses its independence and becomes nothing more than an arm of the Treasury, forced to print money to keep the government solvent. This is a quiet bailout. It is a technical default disguised as monetary policy. Most people walking the streets outside believe the crisis was averted. They see the stock market ticker turning green and assume the danger has passed. They are looking at the surface of the ocean, unaware of the tectonic shift happening on the seabed. It takes a certain kind of skepticism to look past the headlines and read the raw data. It requires a willingness to accept uncomfortable truths over convenient lies. If you are the kind of person who questions why the price of gold is hitting record highs, while the news tells you the dollar is strong, then you are already part of the minority that actually understands the stakes. You are tracking the signal while everyone else is drowning in the noise. This channel is an intelligence briefing, not a cheerleading squad. If you prefer comfortable lies, click away. But if you are ready for the raw data, make sure you are subscribed. We are building a database of truth here, and I want you in it. We need to talk about the collateral damage of this strategy. The Fed has made a calculated decision to save the Treasury from a hard default. They have chosen to sacrifice the value of the currency. They are choosing inflation over insolvency. But here is where the mystery deepens. If the plan is to inflate away the debt, why is the bond market not crashing immediately? Why is there still a bid for U.S. Treasuries? This is where the anomaly appears. This is the glitch in the matrix. When you look at the buyers of U.S. debt, the traditional buyers are gone. China is selling. Japan is selling. The BRICS nations are diversifying into hard assets. So who is buying? The data shows a massive, unexplained intake of treasuries from entities that are often categorized as other in the custodial data. We are witnessing a shell game of epic proportions. The debt is being reshuffled, moved from public view into opaque balance sheets and dark pools. The volatility is being suppressed artificially. It is like a pressure cooker where the valve has been welded shut. The gauge says the pressure is stable, but the heat underneath is intensifying. The narrative of the soft landing is the anesthesia. They need you to stay asleep while they perform surgery on your wallet. They need you to believe that your 401k is safe, that your savings are growing, while in reality, the purchasing power of those assets is being diluted to pay for the sins of the past. But there is a mechanical limit to this manipulation. You can print money, but you cannot print value. You can suppress interest rates, but you cannot suppress the laws of mathematics forever. We are approaching a mathematical event horizon, a point of no return, where the interest payments become so large that they trigger a feedback loop of money printing that no central bank can control. The question you should be asking is not when the recession will start. The recession in the real economy has already begun. The question is, what happens when the bond market realizes that the Treasury has no clothes? What happens when the world realizes that the United States has moved from a risk-free return to return-free risk? To understand the end game, we cannot just look at the numbers. We have to look at the machinery itself. We have to open up the hood of the global financial system and look at the engine. Because what I have found, buried in the technical plumbing of the repurchase agreement market and the bank balance sheets, is not just a sign of incompetence. It is a sign of a systemic feature, a feature designed to consume itself. We are about to engage in an anatomy of a collapse. We are going to trace the flow of every dollar from your paycheck to the Treasury, and from the Treasury into the black hole of debt service. And what we will find there explains exactly why the price of your groceries is never going back down. The system is not broken. It is working exactly as it was redesigned to work, and that is the most terrifying part of all. To understand the severity of this moment, we must strip away the political rhetoric and look at the plumbing of the financial system itself. We need to perform an autopsy on the mechanism of money creation, because what we are witnessing is not a standard economic cycle, but a structural failure of the engine that drives the global economy. In biology, there is a process called autophagy. It occurs when a starving body begins to consume its own muscle tissue for energy to keep the vital organs functioning. It is a desperate act of survival that ultimately weakens the host. The United States fiscal policy has now entered a state of financial autophagy. Let us trace the flow of capital to see exactly where the cancer lies. In a healthy economy, the government issues debt in the form of Treasury bonds to fund infrastructure or innovation, which in turn creates growth that pays off the debt. That is the theory. But here is the reality of the current loop. The Treasury Department issues a bond, which is essentially a promise to pay you back with interest. Who buys this bond? The primary dealer banks are legally obligated to buy this debt. But where do they get the money? Often they get it from the Federal Reserve, which prints new currency to purchase these assets from the banks or accepts them as collateral. This creates a closed loop where the government is effectively borrowing from itself to pay its own bills. For decades, this circular financing worked because the debt load was manageable and the interest rates were near zero. But the mathematical equation has changed. We have now reached the point of saturation. The government is no longer borrowing to build roads or fund research. It is borrowing exclusively to pay the interest on the bonds it issued 10 years ago. When you borrow money to pay the interest on your previous loans, you have met the textbook definition of a Ponzi scheme. In the private sector, this lands you in federal prison. In the public sector, it is called quantitative easing. The system is consuming its own credibility to keep the lights on. And this leads us to the second fatal flaw in the anatomy of this crisis. We must look at the efficiency of this debt. Economists call this the marginal productivity of debt. It measures how much GDP growth is generated for every new dollar of debt issued. In the 1950s, $1 of debt generated several dollars of growth. Today, the ratio has inverted. To generate just $1 of GDP growth, the United States must now generate over $2.50 of new debt. The transmission mechanism is broken. We are flooding the engine with fuel, but the car is not moving faster. It is simply overheating. This is the great decoupling. The stock market and the GDP numbers are going up in nominal terms, but they are being fueled by a currency that is rapidly losing its structural integrity. The prosperity is an illusion created by the debasement of the unit of account. But this dysfunction is not just an abstract problem for economists. It has created a physical danger for the custodians of your money. We need to examine patient zero in this epidemic, which is the commercial banking system. The banks are the unsuspecting victims of the Federal Reserve's pivot. During the years of zero interest rates, banks took your deposits and bought what they were told was the safest asset in the world, which is long-term U.S. Treasury bonds. They loaded their balance sheets with trillions of dollars of this paper, yielding 1 or 2%. Then the Fed panicked. They hiked interest rates faster than at any time in history to fight inflation. This created a mechanical breakage in the bond market. When interest rates go up, the price of existing bonds goes down. It is a mathematical seesaw. This means the trillions of dollars of bonds sitting in the vaults of major U.S. banks are now worth 20 to 30% less than what they paid for them. These are called unrealized losses. As long as nobody asks for their money back, the banks can pretend they are solvent. They can hide the rot in a section of their accounting books labeled held to maturity. But if depositors get scared and demand their cash, the banks are forced to sell these bonds at the current market price. They realize the loss. The capital buffer is wiped out, and the bank collapses. We saw the preview of this with Silicon Valley Bank. That was not an isolated incident. It was a structural tremor. The Federal Reserve is now trapped in a prison of its own design. They have two choices, and both lead to catastrophe. Option A is to keep interest rates high to fight inflation, which will crush the government budget under the weight of interest payments, and likely detonate the banking system by deepening these unrealized losses. Option B is to cut interest rates to save the banks and the Treasury, but in doing so, they will unleash a second wave of inflation that will destroy the purchasing power of the middle class. They have made their choice. The pivot to lower rates is an admission that they are choosing to sacrifice the dollar to save the bond market. They are choosing to bail out the system at the expense of the currency user. This is not a policy error. It is a controlled demolition of the middle-class saver to protect the sovereign debtor. The system is not malfunctioning. It is doing exactly what a debt-based fiat system is designed to do in its final stages. It is transferring real wealth from the productive class to the political class through the mechanism of inflation. The anatomy of this collapse reveals that the engine is seizing up. The gears are grinding against each other because the lubricant of cheap money has turned into the abrasive sand of debt service costs. We have looked at the government and the banks, but there is a third player in this tragedy. There is a group of sophisticated actors who saw this blueprint years ago and have positioned themselves accordingly. While you were being told to buy index funds, they were quietly making moves in the futures market that defy conventional wisdom. The structural integrity of the burning building is compromised, but before the roof caves in, we need to look at the footprints leaving the scene, because the smart money is not waiting for the official announcement of the collapse. They are already executing the exit strategy that we are about to decode. If we strip the casing off the global financial engine and look directly at the diagnostic logs, we find data that contradicts every press release coming out of Washington. The media focuses on the paint job telling you the economy is shiny and resilient, but we are going to look at the stress sensors attached to the chassis. To understand the mechanics of this collapse, we must examine the Commitment of Traders report, or the COT. This is the weekly readout that tells us how the engineers of the financial system are positioning themselves versus how the passengers are positioned. In the futures market, we have two distinct categories of mechanics. You have the commercials, who are the producers, and the banks, the entities that actually build and maintain the plumbing of the system. Then you have the large speculators, the hedge funds, and the trend followers, who are essentially betting on which direction the car is moving. Right now, the diagnostic readings on the 10-year Treasury bond are flashing red. The commercials, the smart money, are holding a record short position against long-duration U.S. debt. Translate this into mechanical terms. The people who understand the plumbing best are betting that the pipes are about to burst. They know that the Treasury has to issue trillions in new supply to cover the interest payments we discussed in the previous section. They know that supply is about to overwhelm demand. While the news anchors talk about a bond market rally, these engineers are bracing for a collapse in bond prices, which mathematically means a spike in yields. They are positioning themselves for a structural failure of the debt market. They are not listening to the Federal Reserve's forward guidance. They are looking at the sheer volume of sludge moving through the pipes, and they know the pressure is too high for the containment vessel to hold. This brings us to the second point of failure in our anatomy of the crash, which is the inverted yield curve. In a properly functioning hydraulic system, pressure should be distributed evenly over time. If you lend money for 10 years, you should get paid more interest than if you lend it for 2 years, because you are taking more risk with your time. That is a normal upward sloping curve. It represents a healthy flow of capital. But for the last record-breaking period, the yield curve has been inverted. The 2-year yield is higher than the 10-year yield. This is not just a technical anomaly. It is a sign that the transmission of the economy is shattered. The system is screaming that the immediate future is far more dangerous than the distant future. The bond market is effectively saying that the engine is going to stall so violently in the short term that the central bank will be forced to cut rates to zero just to restart it. We have never seen an inversion of this depth and duration without a catastrophic mechanical failure following it. The last times we saw readings this distorted were immediately preceding the 2008 financial crisis and the dot-com bust. But this time, the inversion is happening. While the government is running a deficit of 7% of GDP, we are redlining the engine while the transmission is in reverse. Now we must address the software patch that the government has installed to hide these mechanical failures from the public. We call this the Consumer Price Index, or CPI. If the engine is overheating, the logical thing to do is turn it off and let it cool down. But the political class cannot afford to do that, so instead they have recalibrated the thermometer to show a lower temperature. This is the algorithm of your impoverishment. The method used to calculate inflation in the 1980s is completely different from the method used today. They use a mechanism called substitution. If the price of steak goes up, the model assumes you switch to hamburger. If hamburger goes up, it assumes you switch to chicken. If chicken goes up, you eat bugs. The model tracks your decline in standard of living and calls it price stability. They also use hedonic adjustments, where they argue that because your new car has better safety sensors than your old car, the price increase doesn't count as inflation because you are getting a better product. But you cannot eat safety sensors, and you cannot pay your rent with improved pixels on a screen. If we apply the original 1980 calculation method to today's data, using the charts provided by Shadow Stats, we see that real inflation is not 3%. It is closer to 10 or 12%. This matches the rate of monetary debasement required to keep the debt spiral spinning. The system is working exactly as intended. It is designed to report false data to keep the passengers calm while the ship takes on water. This brings me to a critical calibration point, and I need your input to verify the sensor data. I am looking at these official government charts that claim inflation is cooling down to 3%. But when I look at the raw input costs for insurance, energy, and food, the math does not hold up. I want you to be the field reporter right now. Forget what the news says. Look at your own bank statement from this month compared to 2 years ago. Go down to the comments section and tell me the real inflation rate of your household. Is your grocery bill up 3% or is it up 30%? Are you seeing the price of services stabilizing or are you seeing them skyrocket? I want you to drop your location and your real percentage increase below. We are going to build a data set in the comments that reflects the reality on the ground versus the fantasy on the spreadsheet. The aggregate data of thousands of you is far more accurate than a bureaucrat in Washington manipulating a basket of goods he doesn't even buy. This divergence between the official dashboard and the engine room reality is not accidental. It is the necessary fog of war required to conduct the greatest wealth transfer in history. But while the domestic population is being gaslit by these modified metrics, there is a group of observers who are not fooled. They are the foreign creditors who have financed this American experiment for the last 50 years. They are standing outside the machine, watching the smoke billow from the exhaust, and they are making a decision that will change the geopolitical landscape forever. They are not arguing about the CPI calculation. They are simply closing their checkbooks and walking away. The next phase of this investigation moves from the internal mechanics of the U.S. Treasury to the global chessboard, where the dollar is losing its status not because of a political coup, but because the mathematics of our debt have become a national security threat that our allies can no longer ignore. While the American public is distracted by the domestic theater of manipulated inflation data and political infighting, the tectonic plates of the global financial order are shifting with a violence that we have not seen since the 1940s. We established in the previous section that the domestic machinery is broken and relying on false signals to keep the passengers calm. But if you zoom out to the satellite view, you see that the rest of the world has already diagnosed the terminal illness of the dollar system, and they are initiating quarantine protocols. This is the geopolitical web, and right now, it is tightening around the throat of the United States Treasury. We are witnessing a phenomenon that historians will likely call the silent exodus. For half a century, the United States enjoyed a privilege that no other empire in history possessed, which was the ability to print the global reserve currency. We could print paper and exchange it for real goods like French wine, German cars, and Chinese electronics. It was the ultimate trade deficit, financed by the world's trust in our debt. But trust is a finite resource, and the data shows that the reservoir is empty. Look at the ledger of our two biggest bankers, China and Japan. These two nations historically held trillions of dollars of U.S. debt, effectively subsidizing our low interest rates and our high standard of living. But in the last 12 months, the trend line has snapped. China is dumping U.S. treasuries at an aggressive pace. This is not just a trade war tactic, it is a strategic liquidation. They are exiting the burning building before the roof collapses. But even more alarming is Japan. Japan is our closest economic ally in Asia, a vassal state in terms of monetary policy. Yet even they are selling U.S. debt. They are doing it out of necessity to defend their own collapsing yen. When your friends are forced to liquidate your IOUs to save themselves, you know the credit line is officially closed. So here is the terrifying question that links back to our autopsy of the Ponzi scheme in the first act. If the United States government is issuing record amounts of debt to pay its interest, and the biggest foreign buyers are selling that debt, who is buying it? The answer reveals the final stage of the autophagy protocol. The only entities buying U.S. debt in size are the Federal Reserve and regulated U.S. entities, like your pension fund, which are legally mandated to hold safe assets. We are cannibalizing our own retirement futures to fund the government's present insolvency because the rest of the world has stopped sending us checks. This creates a vacuum that is being filled by a new monetary architecture. The BRICS nations are not just holding meetings, they are building a lifeboat. We are seeing a synchronized move by global central banks to accumulate gold at a rate that defies all modern precedents. In the last 2 years, central banks bought more gold than at any time in the last 55 years. You have to ask yourself why. These are not day traders speculating on a chart. These are sovereign nations preparing for a reset of the global collateral system. They have looked at the exponential curve of U.S. debt interest, the $1.6 trillion figure we dissected earlier, and they have done the math. They know that the only way the U.S. pays this debt is by printing trillions of dollars, which dilutes the value of every bond held by foreigners. Buying gold is their way of opting out of this devaluation. They are moving from a system based on promises to a system based on physics. Gold is the only asset that is not someone else's liability. It is the anti-dollar. This is the gold standard 2.0, emerging not by decree, but by the sheer force of survival instinct. The implications of this global rejection are going to be felt not in the corridors of Washington, but at your kitchen table. This is where the macro becomes micro. As foreign demand for the dollar evaporates, the value of the dollar must decline relative to real assets. We import almost everything we consume. We import our energy. We import our electronics. We import the raw materials for our pharmaceuticals. When the dollar loses its standing on the global stage, the cost of everything coming into the country skyrockets. This is the domino effect on the supply chain. You might think inflation is high now, but what happens when the Saudis stop pricing oil exclusively in dollars? What happens when the components for your iPhone or the lithium for your electric car battery are priced in a basket of currencies that excludes the dollar? We are looking at a future where the United States imports hyperinflation. The standard of living you have grown accustomed to is mathematically impossible to maintain without the subsidy of foreign creditors. The intricate web of global trade is unraveling. The supply chains are being rerouted based on political alliances rather than economic efficiency. The West is becoming an island of debt in a world that is rapidly moving back to hard assets. The comfortable illusion that we can print our way to prosperity is shattering against the hard rock of geopolitical reality. The world is watching the U.S. Treasury struggle to pay its interest bill, and they are voting with their wallets. They are leaving the casino. And as they leave, they are taking the value of your currency with them, leaving you holding the bag of a devalued asset class that no one else wants. The trap has been set, the exits are blocked, and the water is rising. Now we must face the verdict of what comes next when the mathematics finally demands its due. We have spent the last 30 minutes dissecting the anatomy of a financial crime scene. We have looked at the cold, hard mathematics of the interest expense spiral. We have traced the exit wounds in the bond market, and we have mapped the flight path of foreign capital leaving the dollar system. But to truly understand what is about to happen to your net worth, we need to stop thinking like economists and start thinking like predators. In the wilderness of the global markets, there are only two categories of participants. There are the hunters, and there are the hunted. The difference between them is not luck. It is information asymmetry. The official story tells you that the economy is a cooperative system where everyone benefits from growth. The predatory logic tells you that the economy is a zero-sum game of resource transfer. Right now, we are witnessing the largest transfer of wealth in human history, and it is not happening through taxes or theft. It is happening through the mechanism of debt debasement. You need to look at what the elites do, not what they say. While the media encourages the middle class to park their savings in government bonds and high-yield savings accounts, the architects of the system are doing the exact opposite. They are not lending money to the government. They are borrowing it. This is the secret that the smart money understands. In a regime of financial repression, where the inflation rate is structurally higher than the interest rate, debt becomes an asset, and cash becomes a liability. The billionaires and the hedge funds are currently taking out fixed-rate debt to acquire hard assets. They are buying farmland. They are buying gold mines. They are buying data centers for artificial intelligence. They are buying Bitcoin. They are essentially shorting the dollar by borrowing it today and paying it back tomorrow with currency that they know will be worth less. They are positioning themselves on the right side of the Cantillon effect, standing closest to the money printer, where the liquidity is fresh, while you are standing at the end of the line, waiting for the trickle-down, which by the time it reaches you has turned into inflation. The trap is set for the passive investor. The average person with a 401k is being herded into a pen of paper assets. You are being told that government bonds are the risk-free rate. But we have proven today that there is no such thing as risk-free return when the issuer of the bond is insolvent. By holding these assets, you are providing the exit liquidity for the whales. You are the one buying the debt that China and Japan are selling. You are the one holding the bag of depreciating currency that pays for the bailouts. This is not an accident. This is the design. The system requires a class of people to hold the bag so that the smart money can escape into tangible value. We are now approaching the moment the trap springs shut. It is what I call the liquidity trap horizon. The Federal Reserve is signaling that they will cut interest rates. The market will cheer. Stocks will likely rally in a euphoric burst of energy. This is the bull trap. The media will declare that the soft landing is achieved and that the good times are here again. This is the moment of maximum danger. When the Fed cuts rates, they are pouring gasoline on a fire that is already smoldering. The structural deficits haven't gone away. The supply chain fractures haven't healed. By easing financial conditions, they will unleash the second wave of inflation, just like the Federal Reserve did in the 1970s. But this time the debt load is 3 times higher. The inflation will not just be in consumer goods. It will be in the scarcity of the very assets you need to survive. The price of things you want, like electronics, might stay flat, but the price of things you need, like energy, insurance, and food, will explode. You will find yourself in a paradox where your portfolio looks higher in nominal dollar terms, but your standard of living is collapsing. You will feel rich on paper while you are becoming poor in reality. This is the ultimate predatory trick, to make the prey feel safe right before the slaughter. The path forward requires a radical shift in mindset. You cannot rely on the strategies that worked in the last 40 years. The era of the 60-40 portfolio is dead. The era of trusting the central bank to manage the business cycle is over. We are entering an era of fiscal dominance, where the imperative of the state is to survive at all costs, even if it means consuming the wealth of its citizens. The government will rewrite the rules of the game to trap your capital inside their burning building. They will turn your bank account into a captive audience for their debt. We are already seeing the early stages of this, with regulatory changes in the banking sector. You have a binary choice. You can remain asleep, lulled by the narrative of the soft landing and the resilience of the consumer, or you can wake up to the predatory nature of the environment you are living in. The whales have already made their move. They have built their arcs. They have diversified out of the system. The window for you to do the same is closing. This is not about getting rich quick. It is about not getting poor slowly. It is about recognizing that the dollar in your pocket is melting ice, and you need to exchange it for something that cannot be printed by a bureaucrat in Washington. Do not wait for the Federal Reserve to give you the all-clear signal. They are not coming to save you. They are busy trying to save the bond market from a mathematical implosion. If you are waiting for permission to protect your family's future, you will be waiting until it is too late. The footprints of the smart money are visible if you know where to look. They are moving away from the blast radius of the sovereign debt bubble. I invited you on this investigation, not to scare you, but to arm you. The weapon you need is not a gun. It is situational awareness. If you want to continue tracking these flows, and if you want to see the specific data points that the mainstream media conveniently ignores, then you need to be part of this intelligence briefing. This is not a request for a like or a subscribe. This is a call to tactical preparation. The storm is not coming. The storm is here. We are simply in the eye of it. In this high-stakes game of macro poker, if you look around the table for 30 minutes and you do not know who the sucker is, then I have bad news for you. The sucker is you. Do not let yourself become the liquidity for their exit.